What's going on, everybody? Thanks for joining us for today's broadcast of Market Makers. My name is Josh Weidman with Hard Money Bankers. I'm a hard money lender and an investor. And I've got our special guest today is Tom Dunkel. Tom is an investor. And my connection with Tom has been almost 20 years ago. We're playing cash flow and, an empty apartment with one of the guys that owned an empty apartment. We, put a card table together and laid out that, that game and played for a couple hours. And I've followed your career at arm's length, and it's just great to have you on here, Tom. How you doing today?
I'm doing great, Josh. It's great to catch up with you, my old friend. Looking forward to our chat today.
That's right. Well, Tom, let's start. Tell me about you. It's been
Sure.
We probably haven't sat down for a cup of coffee in at least 15 years.
It's been a while. Yeah, we got a lot of catching up to do.
That's right. That's right.
We'll keep it punchy though, because I'm getting long-winded in my old age, Josh. So I'll try to keep it brief. But yeah, man. So you and I connected way back when I had just gotten out of corporate America, 2006. I got fired from my corporate job, and that was kind of the kick in the pants I needed to go out and start building my real estate empire. But of course, it was 2006. So those next few years were tough sledding, and learned a lot of hard lessons and lost a lot of money and a lot of sleep. But, I kind of hung with it, stuck it out, started a distressed mortgage debt business, which is still going on today, 14 years later, with my partner, Joe Downs. Along the way, because that business has been pretty successful, it's allowed us to do some other things. So we've done some hard money lending. We were partners in a title company for a while. We picked up some short-term rentals up in the Poconos. But our primary business these days is self-storage. So we started getting into that about 2017, 2018. We started really learning about it, Josh. Started going to the conferences around the country to get educated. 2019, we joined a mastermind group and built out our team, because like Joe and I are really good at certain things, like raising the capital and doing the projections and kind of the financial aspects, but we didn't really know how to find those off-market self-storage deals, so we brought in an expert to help us with that. And we certainly didn't know how to run a self-storage facility, so we had to bring in a group to help us with the operational aspects as well. And so once we put the team together, we went out and acquired our first facility in 2020. And this past week, we closed on our 16th facility. So we've acquired over 600,000 square feet of self-storage, about $46 million worth across 8 states. So it's been a great business. We're really excited about it. And really, we're just getting started.
That's fantastic. That's really fantastic. So I'm gonna rewind here for
sure, of course,
quite a few years, right?
Yeah, I covered about 20 years in about 2 minutes. So yeah.
Well, exactly. That's pretty good. There's a couple of high points that some things that jumped out here that I'm going to address. But when you left corporate America, what were you doing in corporate America? Let's start there.
So I'm a finance nerd by training. So, I got my MBA in finance and accounting. And so I was doing mergers and acquisitions first in the aerospace industry, and then some other industries, third-party logistics, software, IT services, that sort of thing. So, I was a deal guy in my corporate life. And so I just kind of brought those deal skills with me from corporate into real estate.
Okay. That's awesome. So, it's... I kind of was very focused for quite a few years on Philadelphia and Philadelphia real estate market and, rentals and all that kind of stuff, and never looked outside of the city. And you bought a couple short-term rentals in the Poconos. My goodness, that market has absolutely exploded. I can remember when I was wholesaling, getting leads up there for 30 grand for, a nice house in a community or a condo in a community. And you're like, 30 grand, forget it.
Yeah.
And now those places that have just skyrocketed in value.
Yeah, we were, that was, that kind of came about like a lot of things in real estate or entrepreneurship, right, Josh? You kind of stumble into things by accident. And what ended up happening was my partner, Joe, bought a house on Lake Harmony up in the Poconos, and he started and he through that process formed a relationship with a real estate agent up there who was not only selling houses but also selling like investment properties. And so they got to talking, and she let him know about like the monthly or the nightly rate that he could get for this house on Lake Harmony, and his eyes just kind of popped out of his head.
Right.
Are you serious?
Yeah.
So he came back and he's like, hey, we should look at picking up some of these Airbnbs up in the Poconos, and I was like, I don't know, but it's worked out great. We bought them at the beginning of COVID, so of course during COVID, people were
Congrats.
leaving, dying to get out of New York City, dying to get out of Philadelphia. So you've got 15 million people within like an hour drive of the Poconos. So we started off like gangbusters, and that's since tapered off, but the equity is definitely built up in those properties, and the cash flows solid enough to keep our bills paid. So
Sure.
we're doing pretty good there.
That's awesome. That's awesome.
Mm-hmm.
I think that the self-storage market it's really, the first time I heard about it, I honestly thought that, hey, we got all of these regular asset groups, and maybe not regular, but, more conventional asset classes
Sure.
had kind of become saturated in the competition and all that kind of stuff.
Mm-hmm.
And it looked like people were kind of fleeing those for maybe, more risky investments. Come to find out, the risk is a heck of a lot less on self-storage if you do it right.
Mm-hmm.
There's no leaky toilets, there's no crying
That's right.
tenants,
That's right.
evictions don't take 6 months.
Yeah. Exactly.
How did you transition? Not so much how. When did you make the decision, hey, this is really an advantageous market to get into,
Yeah.
And how long did it take you to build that team to really jump in?
Yeah, it's a great question, and we were very diligent about our approach to self storage because we had tried and failed some other businesses many times, and we're like, all right, let's take our time and do it right with this because
Sure.
Thankfully we did have the distressed mortgage debt business, which was going well, and it was throwing off some cash so we could do these other things. So we weren't really under a lot of pressure to get the self storage business up and running. So we took advantage of that luxury to take our time and make sure that we were educated and we understood like the opportunity in self-storage, especially what we were doing is, and what we continue to do is acquire value add self-storage facilities. So these are mom and pop owned facilities that they're just not being run like a business, right? It's kind of like a side thing. Moms and pops, their big KPI, their key performance indicator is, are we full? Because the last thing a mom and pop operator wants to do is have a website, have a marketing program, have a sophisticated management platform, really leverage technology. It's just not in their wheelhouse. So we identify these properties, and it's not unusual, Josh, for us to find a facility where rates are like 30% below market. We've even acquired facilities where rates are 40% below market. So
Wow.
It's really a no-brainer value add strategy to just go in and over time, you boil the frog slowly, but eventually you're bringing the rates up to market. And just that aspect, forget about all the other cool stuff we can do. Just that aspect can really generate great returns for our investors. But you touched on something really key a minute ago, which is just the safety of self-storage. So as an investor myself, and what I talk to our investors about is, hey, we got to be thinking about capital preservation, especially, with the big run up in interest rates last year, and, who knows where the world is going. Let's look at capital preservation. So from that aspect, if you look at loan default rates on commercial real estate, the biggest, of course, is going to be retail, right? Nobody's really going to the store anymore. They're buying everything online. So retail defaults a lot. The other one is lodging, right? Hotels, especially during COVID, like that's always been a very volatile industry, but definitely more so during COVID. Then, of course, now you got office, right? Nobody's going back to the office, so there's a lot of defaults in office. Multifamily, solid, right? Multifamily is a really solid asset class. I invest in multifamily myself, but when you then look at self-storage, it doesn't even show up on the chart. I mean, it's basically about zero. And the big reason is that self-storage is it's really easy. It's really efficient to run it. So
Hmm.
our operating expenses, Josh, like we bring in $100 of rent, our taxes, insurance, repairs and maintenance, utilities, personnel, etc. Those basic operating expenses only add up to about 35, $40. So
Hmm.
that allows us to have, call it $60 left over to pay our debt service and then pay our investors as well. So it doesn't default because we have all that cushion. If things do get rough, we have the ability to adjust our rates, and maybe our operating expense ratio then goes up to 50 or maybe 60, but we still have plenty of cash left over to service the debt, which as a investor looking for capital preservation and then cash flow and growth as well, self-storage is where it's at.
So a couple things here. First of all, comment on retail and office space. I mean, have you seen some of these sales that are going on in like Chicago and New York and even DC, where they I think the last I saw, there was a property in DC that last sold for like $440 million in 2010, and the most recent sale was like $8 million or something absolutely absurd like that.
Right.
It's so crazy to me how
Mm-hmm.
much that market has changed in our lifetime, where
Sure.
yes, Amazon takes a big chunk out of retail, and
Mm-hmm.
Temu and all these others, but who
Yep.
would think that all of the major retailers in the
Mm-hmm.
country are just closing shop and selling stuff online? I
Mm-hmm.
mean, it's pretty amazing. It's pretty amazing.
It is. And you know what's happening, Josh, to those empty, Sears and Kmart buildings? They're being converted into self-storage.
That's crazy too. That I
Yeah.
didn't realize that.
Oh
I
yeah.
knew like a lot of the malls are getting bought up by Amazon at like 10 cents on the
Yeah.
dollar, and but
Yep.
I didn't realize they were converting it. Okay. All
Yep.
right.
Some of those big boxes, yep, are getting converted into self-storage.
Well, do you think that that might be a function of the cost of housing right now, where people are essentially moving into maybe less than they need or less than they want for sure,
Sure.
and they've got to put their stuff somewhere,
100%.
Yeah.
Yeah, 100%. I mean, we're still so we're such a let's face it, America is a nation of hoarders, okay?
Yeah.
If you look at the headlines from like a week or two ago, there was one headline that said something along the lines of, credit card balances have never been higher, and now the credit cards are starting to default, right? And then not a day later, I see another headline that says consumer spending robust. The Fed isn't going to be able to cut rates because consumer spending is growing. So people, like, we love our stuff, right? I mean, you can hop on your smartphone right now and go to your Amazon app and pretty much buy whatever you want, right?
Right.
So people are doing that, Josh. And so but you're right, they are not able to buy the big houses anymore, or they don't want that size of a footprint, but they still want their, the mountain bike and the kayak and the whatever. So they're using self-storage as just an extension of their overall kind of housing strategy.
Yeah. Yeah, that's really fascinating. What kind of markets do you target for this? I mean, are you looking at, suburban, urban markets, or are you looking
Mhm.
everywhere?
Yeah, so for us, we're Bellrose Storage Group. We're a smaller, kind of value add, opportunistic player. So what that does is that it kind of pushes us into the secondary and tertiary markets. So we're not in Baltimore, we're
Mhm.
outside Baltimore. We're not in Atlanta, we're outside Atlanta. But those are still kind of path of progress areas where there's still housing developments going in, and then so those are the things that we look for. We look for housing starts. We're looking for growing populations. We're looking for growing incomes. We're looking for low poverty. We're looking for a decent amount of renters versus owners in that kind of market, because renters tend to be users of self-storage. So we're looking at all those kinds of higher level demographic things. And then of course, on the other side, we're looking at the competition, right? What is the amount of storage available in this market, and is it too much? Is it too little? So we're looking for those supply and demand imbalances to pick the right location for a self-storage facility acquisition.
Okay. Do you? I think I saw your most recent purchase was somewhere in the Midwest, right?
Yeah, we have again through our mastermind community, right? It's always good to have a network and friends,
That's
in
right.
the business. So we had a friend of ours we've known for 4 or 5 years. Great guy. He's out there in Illinois, and he ran across this facility outside of Minneapolis in Minnesota, which wasn't really on our radar, but he brought it to us like, hey, because he's more of a manager operator guy. He's less of like a deal, transaction, raise the capital kind of guy. So he came to us and said, "Hey, you want to partner on this?" We said, "Sure." The numbers look great. He's going to bring his experienced team in to run it. We brought our team in to do the deal vetting and get the capital raised and get the loan lined up. And so it was a great partnership. So we're excited to get that started.
It's almost like you set me up for my next question, right? So
softball, here you go.
That's right. That's right. The financing on this is
Yeah.
is really interesting because I get calls for self-storage all the time. And it's something that we will fund, but our leverage points are not, they're not necessarily
Sure.
desirable.
Yeah.
My partners in Maryland, they invest in self-storage through one of our friends, and what kind of leverage points are you looking at on this kind of stuff, and what kind of rates and terms are these? Is this like a commercial mortgage? Is it resetting? Is it, tell me a little bit about that, if you will.
Yeah, of course. Yeah. So on the debt side, Josh, we're typically getting the best execution from credit unions and small banks that are local to the facility.
Yeah.
And so the leverage looks like, so I'll compare like a year or so ago with today. So, year and a half ago, we acquired a facility out in Bowling Green, Kentucky, and there was a small local lender that really liked the deal, really liked the property, and they were offering us 80% loan to value.
That's fantastic.
Yeah, with a 30-year amortization, and it was like, wow. But being a veteran of the great financial crisis, our numbers worked at 75% LTV. So I was like, all right, we're gonna stick with 75. And I'm glad we did, because of course, with the run up in interest rates last year, it definitely took a toll on the self-storage industry, brought down occupancies and rates and that sort of thing. So I was glad that we were prudent there and conservative and only took 75%. But I want to say the rate on that one back then was maybe 4.5, something like that. Right? I know. Yes. Laughable. I know.
Right.
I know.
And you're griping. You're like, you sure you can't do 4.25 at the time?
Exactly.
Right.
But then so the loan that we just closed was 65% loan to value at 7.25. And that's a 20-year amortization, and it resets after 5. So that's more typical with what we're seeing. That was a small local lender up in Minnesota.
Yeah.
So that's more typical what we've been seeing recently. In fact, so we closed 2 deals in the last 2 weeks. So the prior to the deal that we closed just the week before, it was only 53% loan to value. And so we've had definitely had some shifts in the capital markets on the debt side for sure.
This mimics so much. These changes in financing, it mimics so much what we saw after 2008, right? I mean, in that, capital became restricted. You were paying more for it. You had to bring more capital to the deal. There was just, there were more opportunities, but less opportunity to take advantage of what was there, right? And so, it's almost, I don't know the word, when you choose the right word, I guess. It is, it's basically, you're buying today if it makes sense. You're buying today, knowing that at some point in the future, capital markets are going to change again.
That's right.
And you'll look like a genius.
Correct. Hopefully that's the idea, Josh. Yeah, totally.
Yeah, but it's just such an interesting cycle that, having gone through 2008, I remember, like, you got in 2006, right? You started buying properties. I was so upset that I missed the tide of, you buy a house and 6 months later you sell it for 50 grand more, and you're like, you look like a rock star, right?
Yeah.
I got in the tail end of that. Now, in retrospect, I'm so glad that I didn't, because I probably would have lost, my shirt and more. And watching the cycle repeat itself, and banks get tight, other lending institutions step
That's
in,
right.
and then all of a sudden we start all over again,
That's
and
right.
it's just it's fascinating to watch that cycle. And
Mhm.
what is it,
That's what
20
that's what we've been explaining to our
years ish?
investors is, hey, it's 2012 all over again, so I know
Yeah.
things look scary, who knows what's going on with interest rates. It's an election year, we've got wars and conflicts and kind of crazy stuff, but this is the time to jump in, and you got to be patient. Things aren't going to happen in 3, 6, 9 months. You got to, you got to be looking at 3, 6 years. So, get in, be patient. Again, self-storage, we really love the asset class because it's low default rate, high cash flow, like we talked about a minute ago. So, but it takes that step of faith, which is why, here at Belrose Storage Group, we always invest in our own deals alongside our investors. So, we're eating our own cooking,
Right.
and whatever other metaphor you want to throw in there. So we're encouraging investors to, take that longer term view right now. It's, back when COVID was rocking and rolling, and, people were having to store, right? They were having to change their spare bedroom into a home office, right? And so it was driving all kinds of demand. And so we were rocking and rolling. We're like, our occupancies were way up. We're pushing rates all the time. And it was like, woohoo, we're geniuses. But, then, kind of things shifted, and we were like, wow, we really need to focus on operations and getting our, technology down, and really, being much more strategic and surgical about our rate management and those kinds of things. But yeah, this is the time in the cycle, Josh, where, if people can jump in, and, we'll definitely get that rise going again, because it's just the way it works, right?
Right. And it's what do they say? The interest rates and liquidity are, it's an inverse relationship to the number of opportunities that you have a lot of times, and
That's right.
it's just picking
Oh
and
yeah.
choosing the best that are out there, so
Oh
that
yeah.
your highs are really high and your lows are still pretty good. That's not too
That's
bad.
right. Yeah, it's definitely a battle out there. We're definitely having a battle for deals. We're very, very disciplined about our acquisition approach, and the numbers have to make sense. Like,
Hmm.
because so many brokers and others are out there, really trying to push the envelope, and we say no a lot. I mean, we look at hundreds of deals for every one that we close. I mean, it's really pretty crazy.
Well, actually, that's a very good that's a good topic to pursue.
Mhm.
Have you seen changes in the amount of competition? Because there are a few guys in Lancaster County that have really developed very large portfolios of what am I trying to say? Very large portfolios of these type of storage units,
Mhm.
and they don't seem to want to go back to single family homes like that.
Mhm.
They're or not even single family, but multifamily, and
Sure.
they're sometimes that can make it awfully difficult to compete when you've got somebody that's sitting on, a $30 million portfolio with tons of liquidity and cash flow. And,
Sure.
it's almost like dealing with private equity to a certain extent.
Yep. Yeah, it's definitely competitive, and like during the boom of storage, a couple years ago, you were just constantly hearing about this, this new fund or that new fund, and these guys are raising 20 million, these guys are raising 50 million, these guys are raising 100 million, so there's all kinds of money, being thrown at self storage, which made it really difficult for us because a lot of that money was lower cost of capital, so they can afford to pay more for the facility than we can, and so we kept getting outbid on a bunch of deals, but we had to kind of stick to our diligent process and not get sucked into the competitive nature of it, right? And try to one up the next guy,
Yeah.
but it was hard, and we definitely last year 2023, we wanted to acquire 10, 12 facilities. We were only able to acquire 3, and that's just what we had to do to stick with our process and our system.
Yeah.
But we definitely run into that where it's just competitive. But I'll tell you our secret.
Tell me. I won't tell anybody.
Yeah, right. Here's the secret. And I tell you what, this works. I'm sure it works in residential, multifamily, whatever asset class you're in. This technique works in this kind of market today. Get in front of the seller in person. And because I can't tell you, right? Like, so how many mailers are these sellers are getting? A gazillion mailers. They're getting phone calls. Their voicemail box is full of people trying to buy their stuff, right? Trying to buy their property. What we've been doing here is my partner Joe is in charge of acquisitions. He just got back from Georgia, actually. So he set up, I think, like 4 or 5 in-person meetings with owners. And then he did like another 4 or 5 just drop bys of at facilities in this market that we really like, where we're trying to get some penetration there. And it works, especially with these mom and pop owners, right? Because generally speaking, these are more traditional, older folks, and they want to shake your hand and they want to look you in the eye to take care of business. They're not going to do business over the phone, over a Zoom, from a flyer, whatever. They want to see you. They want to get to know you. They want to, have that rapport built so they know who they're doing business with. So get out in front of your sellers.
Well, listen, I think that's the truth in any market. I don't know if you've, there was a couple young guys just out of college. This is several years ago, but in Francisville. And in Francisville, there were these single story, single family row houses that were like 1,000 square feet, 2 or 3 bedroom, built in the 1950s.
Right.
But the zoning on these buildings allowed for 5-story condos, right? And everybody's right. They're throwing money at these people and sending mailers and everything. These guys, they'd get down to the corner and buy some sodas and like knock on the door and hand them a soda and start talking to them. And it was a long play, but they developed that relationship. And don't you know it, they're the ones that get the contract, build the condos, and make $1 million on the deal.
Yeah.
It's stories as old as history. Like, people like doing business with people that they like. That's
sure. Yeah. 100%.
That's pretty cool. That's really cool. I mean, it takes some, you definitely have to have a product that you're trading in that makes that travel and the time worthwhile. If you're doing one single family home a year, it's tough to do, but
no, definitely not.
Yeah. That's awesome. So Tom, I'm negligent here. How do people say, if somebody wanted to invest with you, or they wanted to get more information about what you're doing, how do they get in touch with you?
Sure. Yeah, of course. So I'm Tom Dunkel. I'm Chief Investment Officer at Belrose Storage Group out here in Wayne, Pennsylvania. So you can go to belrosestorategroup.com. Belrose just has one L in it, BELROSE, storagegroup.com. And, or you can just Google my name, Tom Dunkel, Dunkel. I'm all over, LinkedIn, Facebook, Instagram. We've got a lot of social media presence out there, and, we like to add value to our investor community out there, let them know, what we're up to, what we're seeing, what, the good, the bad, the ugly of what's happening in self-storage, in our portfolio, deals that we're looking at and turning down, things that, deals that we're looking at are falling apart, challenges with lending, just all, we're just an open book, because we want our investors to understand what we're doing. So yeah, we're out there all over the place. If you can't find me, I don't know. I don't know what to tell you. You're not looking very hard.
That's awesome. Yeah. Tom, it is really fantastic to talk to you again. Like I said, it's been few years.
Too long, buddy.
We were saying before the show, like, I didn't have any kids the last time we really sat down. My oldest just turned 15.
Oh,
and,
wow.
I think we were talking about the cost of daycare as the kids got older at the time. Right. And now your oldest is out of college, right?
Yep. Now this kid over my shoulder right here, he's going in the Navy next week. So after graduating college, he'll be an officer in the U.S. Navy, heading to submarine school.
Oh, that's fantastic, man. You got to be proud of him. That's great. That's really
very
great.
Proud of him. Yep.
That's awesome. Well, look, Tom, really a pleasure. If you're looking to invest, you guys out there are looking to invest in storage, please reach out to Tom. if you just have questions or whatever, he is a wealth of knowledge, as you can tell here. And if you're looking for a hard money loan, whether it's for storage, commercial, residential properties, give me a call. You can reach me online at hardmoneybankers.com or give me a call at 717-213-8488. All right. Awesome. Tom, thanks a lot. We'll be back here next week. And till then, you guys have a great day. All right.